We were taught that money begins at a government printer. Paper rolls out, ink dries, bills circulate. It is a clean story. It is also wrong, because the most important money in modern life is never printed. It appears silently on a screen at the moment a contract is signed. That quiet moment, not the printer, is where the system truly begins. When someone walks into a bank for a loan, no vault opens and no stored pile of money is handed over. No armored truck arrives. Instead, a banker types numbers into a computer. A deposit is created. A debt is created at the same time. This is not symbolic, it is literal. Most money in the modern economy is created this way, through mortgages, business loans, student loans, and credit cards. Banks do not lend existing money. They create new money by issuing debt. One keystroke creates two entries, an asset for the bank and a liability for the borrower. This mechanism carries a structural consequence. When loans are repaid, the principal disappears from the system. It is destroyed. Only interest remains as bank income. That means the money supply depends on continuous lending. If banks stop lending, the economy does not merely slow, it contracts. Less lending means less money. Less money means less spending. Less spending triggers layoffs, defaults, and cascading fear. Growth in this system is not optional, it is mandatory. This is why credit freezes cause panic. This is why recessions spread faster than expected. Central banks step in not because they want to, but because they must. They lower interest rates, inject liquidity, and backstop failures. Yet they do not create most of the money people use. They influence the price of money and stabilize the system, but commercial banks do the actual creation. This distinction is rarely explained and deeply consequential. Where money enters the system matters. New money flows through credit channels first, into assets, housing, and financial markets. Prices rise before wages do. Asset holders benefit before workers do. Inequality widens even in economies labeled healthy. This is not a conspiracy, it is plumbing, a predictable outcome of how money is introduced into circulation. Debt grows exponentially, incomes do not. Interest compounds, paychecks crawl. Over time, the system requires more borrowers, larger loans, lower rates, or all three. When that expansion stalls, the system strains. The crisis of 2008 was not just about greed, it was a credit-dependent system colliding with its limits. Borrowers failed, lending stopped, money vanished, and governments intervened to prevent a collapse of the money supply itself. Today, debt levels are higher, interest rates have risen, the margin for error is thinner, yet the public story has not changed. We still talk about printing money, we still debate budgets as if money were a fixed pile. It is not. It is a process, a flow, a fragile confidence machine built on promises about the future income, future growth, future stability. When confidence holds, the system functions smoothly. When it cracks, everything feels sudden and uncontrollable. So the real question is not whether this system is good or bad. The question is whether a world built on ever-expanding debt can remain stable in a world with real limits. Because once you understand how money is actually created, you begin to notice how often it needs rescuing, and you are left asking who the system was truly designed to serve.